What if I told you millions of people stopped researching companies, instead using phones to instantly mimic the financial moves of the ultra-wealthy? The targets of this obsession are specific: high-profile billionaires, famous hedge fund managers, and especially elected officials. A specific assumption drives this mass behavior. Deep down, everyday retail investors are asking if the people passing the laws and controlling the capital possess a level of market knowledge that the public simply cannot access. But there is one invisible mathematical flaw in this strategy, and later in this video I'll show you exactly how ignoring it can wipe out an amateur's portfolio. Modern investing is increasingly less about investigating a company's product and more about tracking an individual's behavior. Stock picking used to require hours of fundamental research into earnings and market conditions. Today, many investors just open an app and wait for a notification telling them what a billionaire just bought. The process is fast. An insider files a disclosure of a stock purchase, the internet notices, the trade goes viral across financial social media, and within hours, a massive crowd of retail traders swarms the exact same ticker. This strategy exploits a deep-seated human trait. We are biologically wired to trust authority figures, especially in environments of high uncertainty, where our own wealth is on the line. This chart shows the widening gap between the rising cost of living and a decade of stagnant median purchasing power. Between inflation and mounting debt, the financial system feels increasingly rigged against the average person. For those feeling left behind, mimicking a politician's portfolio feels like finally gaining the same information advantage as the people who write the regulations. For millions of users, copy trading is a desperate attempt to buy their way into a system they believe they are otherwise locked out of. But there is a fatal flaw in the timeline. There is a massive, legally permitted delay between the moment an insider executes a trade and the moment the public is actually allowed to see it. This line graph maps the exact mechanics of the trap. Here is the insider's low-priced entry point. What follows is a quiet period of public disclosure delay. During this gap, the elite investor requires a massive influx of late buyers, known as exit liquidity, to eventually sell their shares at peak profit. As we extend the graph, the public disclosure finally hits the internet. Retail investors enter with maximum excitement, which pushes the asset to its highest possible price. Like at that peak, the insider exits, taking their profits and leaving the public holding the bag as the price drops. Amateur investing relies on two specific emotional failures. Greed pushes people to buy late into a skyrocketing trend, and panic forces them to sell at the bottom when the hype collapses. Think back to the viral healthcare trades of recent years, where officials bought in early, the internet chased the momentum weeks later, and thousands of late adopters watched their accounts drain as the smart money left. What appears to be a financial shortcut is mathematically designed to function as a wealth extraction trap. Modern trading applications accelerate this exact process, using instant push notifications, trending user leaderboards, and immediate trade execution to keep their users constantly engaged. These frictionless interfaces deliberately blur the line between a serious financial exchange and a dopamine-driven social media feed. In this environment, logical financial planning entirely disappears. A screen flashing bright green with constant VI alerts erases the ability to think about long-term consequences. When you eliminate the friction of traditional research, raw emotional excitement replaces careful risk management. The app economy gamifies the process of losing capital to the establishment. Actual institutional wealth is never built by mindlessly copying the notifications of other traders. The most successful investors rely on a concept called conviction. They don't just want to copy a move. They want to thoroughly understand the complex data and a specific reasoning behind why the transaction was made in the first place. Decoding an insider's logic requires deep fundamental research into balance sheets, supply chains, and macroeconomic shifts. It's a process that happens beneath the surface of a simple app interface. Smart money follows its own rigorous conviction, but the crowd is reliably led into a trap by hype. Millions of people are attempting to purchase absolute certainty in a market defined by its unpredictability. The market has a brutal habit. The moment a financial strategy is universally celebrated as easy money, it immediately becomes a systemic hazard. In the stock market, the herd is punished for its timing. The crowd always arrives last. So you have a choice to make. Will you put in the hard work to trust your own research, or will you remain a follower, hoping to catch the leftovers of political elites? True financial independence requires discipline. It can only be achieved by breaking free from the psychological traps of